The Statement of Shareholders' Equity, also called the Statement of Stockholders' Equity or Statement of Owners' Equity, shows the impact that a company's operating and financing activities have on shareholders' equity. Total shareholders' equity is shown on the balance sheet, and the Statement of Shareholders' Equity shows what caused the changes on the balance sheet from one period to the next. There are 4 things that typically cause changes in the value of shareholders' equity: earnings, dividends, issuing stock, and repurchasing stock. If any of these events occur during the period being measured, they would be summarized in the Statement of Shareholders' Equity. A company's earnings are its revenue minus its expenses. Any profits will increase shareholders' equity, and any losses will decrease shareholders' equity. Dividends are payments made to shareholders out of a company's earnings as a return on their investment. These payments decrease shareholders' equity by the amount of the dividends paid. Issuing stock to shareholders increases shareholders' equity by the amount the shareholders pay to the company to purchase the stock. And the repurchase of stock by a company decreases shareholders' equity by the amount the company pays to repurchase its shares. The repurchased stock is called treasury stock. There is one other component that you'll see on these statements, called Other Comprehensive Income, or OCI. This category is complicated and beyond the scope of this course, but the easiest way to explain it is that it represents certain gains and losses of the company that are not reflected in the income statement. One example is long-term gains and losses on a company's pension plan assets. The Statement of Shareholders' Equity isn't usually the first financial statement used to evaluate companies. Investors and others are more likely to focus on the balance sheet, income statement, and cash flow statement because they provide better information about a company's operating performance. It's used by analysts as it highlights the amount of stock that has been issued and repurchased during the accounting period, as well as the dividends paid, but generally speaking, it's secondary to the other financial statements.